There's a comforting myth about modern finance, that it was built in marble hall by brilliant minds through innovation, trade, and progress. But if you rewind far enough, past the stock exchanges, past the central banks, past even the Industrial Revolution, you find something else, something quieter, something darker. You find ships, wooden hulls cutting through the Atlantic, not carrying gold, not carrying spices, but carrying people. And here's the unsettling truth. Modern banking didn't just grow alongside the transatlantic slave trade. It was engineered to make it possible. Setup. The problem money had. Before the 1600s, global trade had a limit: distance. If you wanted to trade across oceans, you needed enormous upfront capital. Ships, crews, supplies, insurance. It was expensive, slow, and extremely risky. One storm, one pirate attack, one failed voyage, and your entire investment vanished. So most merchants stayed small. Trade existed, but it didn't scale. Then came a new kind of trade, one that promised enormous returns: the forced movement of enslaved Africans across the Atlantic. But there was a problem. No single merchant could afford it alone. And that's where finance stepped in, not as a bystander, but as the solution. The slave trade didn't just use financial tools, it forced their creation. Part 1. The invention of risk. Insurance. Imagine you're a merchant in the 1700s. You're preparing a voyage from Europe to West Africa, then across the Atlantic to the Americas, and back to Europe. This is what becomes known as the triangular trade. Each leg carries different goods: manufactured goods from Europe, enslaved people from Africa, sugar, cotton, tobacco from the Americas. The profits? Enormous. But the risks? Even greater. Ships sank, diseases spread, rebellions occurred, and here's where something disturbing happens. To make this trade viable, merchants begin to insure not just ships, but human beings. Enslaved Africans are listed as cargo, insured like barrels of sugar, and institutions step in to manage this risk. One of the most infamous examples is the Zong Massacre. In 1781, the crew of the slave ship Zong threw over 130 enslaved Africans into the ocean, not because they ran out of food, but because of insurance. The crew claimed the loss as cargo jettisoned to save the ship, a category that allowed them to collect compensation. And in court, what the case wasn't about murder, it was about property, whether the insurance claim was valid. This is what early financial systems were optimizing for, not morality, efficiency. When human lives become line items, finance doesn't just reflect reality, it reshapes it. Part 2. The rise of banking power. As the slave trade expanded, so did the need for capital, and banks began to emerge as central players. They weren't just storing money, they were funding voyages, extending credit, managing transactions across continents. Cities like London, Liverpool, Bristol, Amsterdam, they grew rich from this system. And with that wealth came institutions, banks that still exist in various forms today. They financed ships, they provided loans backed by future profits from plantations. They handled payments between traders, plantation owners, and manufacturers. Here's the key shift. Money stopped being tied to physical goods alone. It became tied to expectation, future value, projected profit. And what was the most reliable source of that profit? Plantations powered by enslaved labor. The more predictable the suffering, the more stable the investment. Part 3. Credit. Turning humans into collateral. Let's talk about credit. Today you might use credit to buy a house, start a business, or invest. But in the 18th century, credit did something else. It turned enslaved people into financial assets. Plantation owners didn't just buy enslaved Africans outright. They borrowed money to purchase them, and those enslaved individuals became collateral. If the plantation owner couldn't repay the loan, and the bank could seize the property, which meant people. This created a system where banks financed the purchase of enslaved labor, plantations produced goods like sugar and cotton. Those goods were sold for profit. Profits repaid the loans with interest, and then the cycle repeated. over and over. This wasn't random exploitation. It was structured, systematized, optimized. Slavery wasn't just a social system, it was a financial machine. Part 4, Global Networks. The first financial system. As this system grew, it required coordination across continents. You couldn't physically move gold fast enough to keep up, so something new emerged. Bills of exchange, early forms of paper money. A merchant in London could issue a document promising payment in Jamaica, and a plantation owner could use that document to pay debts in America. Banks acted as intermediaries, verifying trust, facilitating transactions, reducing the need for physical currency. This was the birth of global finance, a network of credit, trust, and obligations spanning the Atlantic. And at its center, the trade in enslaved people. The first global financial system wasn't built on industry, it was built on extraction. Part 5, Industrial Revolution. Where the money went by the late 1700s and early 1800s, something changed. The Industrial Revolution began. Factories rose, machines replaced manual labor, and suddenly Britain and parts of Europe experienced explosive economic growth. But here's the question: where did the capital come from? Industrialization required massive investment. Factories weren't cheap. Any infrastructure wasn't cheap. And historians point to a key source of that capital: profits from the slave economy. Cotton from American plantations fed British textile mills. Sugar profits flowed into banks and investments. Insurance companies, shipping firms, and financial institutions, all enriched by the slave trade, reinvested their wealth into industry, into expansion, into modern capitalism. The factories that defined modernity were financed by a system built on bondage. Part 6, Abolition, but not the end. In the 19th century, abolition movements gained strength. Slavery was outlawed in Britain in 1833. In the United States, it ended in 1865 after the Civil War. But here's the part that often gets overlooked. When slavery ended, the financial system didn't collapse. It adapted. In Britain, the government compensated slave owners, not the enslaved. The enslaved received nothing, but owners were paid millions. And that money, it stayed in the financial system, invested, compounded, passed down. Banks continued operating. Insurance companies evolved. Credit systems expanded. The structures built during slavery didn't disappear. They became the foundation for modern finance. The system didn't end. It evolved. Part 7, the legacy in modern banking. Today, global finance is vast. Banks manage trillions of dollars. Markets move at the speed of light. But if you trace the lineage of these institutions, you often find connections. Early banks that financed slave voyages, insurance firms that covered slave ships, trading companies built on plantation profits. This doesn't mean every modern bank directly profits from slavery today, but it does mean the system itself, the structures of credit, risk, and capital, were shaped during that era. And that history leaves a mark, because systems remember, even when people forget. Part 8, the modern parallel. Now bring this forward. Today, we live in a world of complex finance, derivatives, hedge funds, global supply chains, digital currencies. Everything feels distant, abstract, but at its core, the system still operates on the same principles: risk, profit, efficiency, and sometimes those principles still disconnect outcomes from human cost. Think about modern labor exploitation, supply chains that rely on underpaid workers, industries where profit margins depend on minimizing human welfare. The systems are more sophisticated now, but the logic, it hasn't disappeared. When profit is prioritized above all else, history has a way of repeating, just in different forms. Part 9, why this matters. This story isn't about assigning guilt to individuals today. It's about understanding systems, because systems shape outcomes. They determine who has access to capital, who accumulates wealth, who gets left behind. The transatlantic slave trade wasn't just a moral failure. It was a financial innovation, one that helped build the modern world. And if we ignore that, we misunderstand the foundation we're standing on. Final reflection. So the next time you think about banking, about loans, investments, global markets, remember this: these systems weren't born in isolation. Heck, they were forged in a specific historical context, one where human lives were reduced to numbers, where risk was calculated in suffering, where profit depended on control. Modern finance is more advanced, more regulated, more complex, but its origins, they tell a story we're still grappling with. Because history doesn't disappear, it compounds, just like interest. If you want more deep, cinematic breakdowns of the hidden forces shaping our world, history, money, power, subscribe to the channel. Because the systems we live in today make a lot more sense once you see where they came from.